Welcome, my friends, to this channel. Mental accounting is a well-established concept in behavioral economics that describes how individuals tend to categorize, evaluate, and treat money differently depending on its source, its intended use, or the mental label they attach to it. And while at first glance this may appear to be merely an abstract academic definition, in reality it has profound implications for everyday financial behavior, because the way we frame and mentally organize our financial resources directly shapes how we save, spend, and plan for the future. For instance, people typically consider their monthly salary to be serious money earmarked for rent, bills, and essential living expenses, whereas they classify a work bonus, a tax refund, or a small monetary gift as extra money that can be spent more freely on leisure or discretionary purchases. Even though logically both sources of money are identical in value, yet the human brain does not treat them equally, and this discrepancy reveals a critical psychological bias. Without conscious awareness, individuals create separate mental accounts and manage them in inconsistent ways, sometimes making irrational spending decisions simply because the label on the money feels different. However, this same psychological tendency, if understood and applied deliberately, can be transformed into a powerful tool for disciplined saving and long-term wealth building. Because by assigning each portion of income a clear mental identity and purpose, one can reduce impulsive spending and increase commitment to financial goals. From a psychological perspective, the mechanism is straightforward. Human cognition seeks structure and meaning, and when money is left undefined in a single undifferentiated account, it loses salience and often disappears into daily consumption without trace. But when the same amount of money is placed into a separate mental or physical category, such as an emergency fund, a vacation fund, or a retirement fund, the symbolic framing enhances emotional attachment and self-control, making it harder to spend casually and easier to preserve for its intended goal. Experimental studies in behavioral economics have consistently shown that labeled money is stickier than unlabeled money, meaning people are more likely to keep it intact, which demonstrates the practical benefit of consciously practicing mental accounting. From a practical perspective, this can be operationalized by dividing monthly income into distinct categories or containers. A portion set aside for emergency savings to cover 3 to 6 months of essential expenses. Another portion for short-term goals such as travel, technology purchases, or education. Another for long-term objectives like homeownership or retirement, and yet another portion for investment growth. And although the numerical proportions can vary depending on income level and individual circumstances, the crucial point is that each segment of money is not allowed to blend invisibly into general consumption, but is instead isolated and purpose-driven. And this structure gives individuals a tangible sense of control and progress, because instead of asking vaguely at the end of each month where all the money went, they can see precisely which accounts grew and by how much, and this visibility strengthens motivation. From a scientific perspective, mental accounting is linked to cognitive heuristics and biases such as loss, aversion, and present bias. Individuals are naturally inclined to overvalue immediate consumption and undervalue future gains, which explains why saving feels difficult. But by reframing the act of saving as filling a specific account with a concrete meaning, the future becomes more tangible and the psychological barrier of present bias is reduced. Similarly, because humans dislike breaking a mental account, they are less likely to spend money from a labeled fund than from a general pool, even if doing so would be logically equivalent, and this behavioral asymmetry can be harnessed for positive outcomes. From a conceptual perspective, money can be compared to water. If left to flow without channels, it will seep away into the ground. But if directed into reservoirs, it will accumulate and become a resource for future use, or it can be compared to seeds. Scattered randomly, they may be eaten by birds or fail to grow. But if planted intentionally, in designated soil beds and watered consistently, they will eventually become fruitful trees, and in the same way, income that is given no mental designation evaporates in day-to-day spending, whereas income that is consciously categorized begins to grow into something meaningful. A further analogy is that of containers or jars. If every dollar is poured into one undifferentiated jar, the liquid soon spills and disappears. But if distributed into several smaller jars labeled with names and purposes, the same liquid becomes organized and protected, and the simple act of labeling changes its destiny. This is not mere metaphor, but a psychological truth supported by empirical evidence, as the act of labeling itself changes behavior. From another angle, one can see mental accounting as a form of self-commitment strategy. By pre-allocating funds to specific categories, individuals reduce the mental effort required to resist temptation later, because the decision has already been made at the moment of allocation, thus reducing cognitive load and preserving willpower. And this explains why even small allocations such as placing $10 a week into a jar marked future home can over time create not only financial resources, but also a growing sense of discipline and identity, reinforcing the idea of being someone who saves purposefully. Furthermore, mental accounting provides psychological comfort. When individuals know they have a designated emergency fund, their anxiety about unexpected expenses decreases, and when they see their long-term account growing, their confidence in future stability increases. And when they achieve milestones in their short-term accounts, such as funding a planned trip, they experience satisfaction without guilt, because the expenditure aligns with a pre-committed goal, and these emotional reinforcements create a virtuous cycle that makes continued saving easier. Thus, the academic principle translates into real-life well-being. Moreover, the practice of mental accounting is not dependent on income level. Even those with modest incomes can benefit, because the effectiveness lies not in the size of the amounts, but in the framing and consistency of the behavior. And this insight is crucial. Waiting for higher income before beginning to save often results in perpetual delay, whereas beginning immediately with small allocations creates momentum and habit, which are far more valuable in the long run than occasional large deposits. The phenomenon also aligns with findings in psychology regarding goal setting and motivation. Specific, measurable, and meaningful goals increase adherence compared to vague or abstract intentions, and mental accounts effectively transform abstract goals into concrete categories that can be tracked and celebrated even if incrementally. The scientific literature also indicates that people are more likely to honor self-created rules when those rules are visible and concrete, which further supports the strategy of labeling and dividing money into accounts. Whether physical like separate bank accounts, envelopes, jars, or digital like apps and budgeting tools, and the form matters less than the principle. Money must not be left unassigned. The overarching conclusion is that mental accounting, when applied consciously, transforms ordinary financial management into a structured system that leverages natural cognitive tendencies instead of fighting against them, and in doing so, it creates a bridge between behavioral economics theory and everyday financial practice. To put it succinctly but comprehensively, mental accounting is the science and art of giving money a name before it disappears, of channeling financial energy into structured containers so that it accumulates instead of evaporating, of transforming abstract numbers into meaningful categories that inspire discipline, control, and long-term growth. And while it can sometimes lead to irrational choices if left unconscious, when applied deliberately and systematically, it becomes one of the most effective strategies for personal financial stability, enabling individuals not only to protect themselves against emergencies and achieve planned goals, but also to cultivate a psychological sense of order, clarity, and empowerment that permeates their broader relationship with money and with the future. If you found this video helpful, don't forget to subscribe for more insights on saving, investing, and building a smarter financial future.